India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, starting a new week, a holiday-shortened one at that, midweek holiday for the 2nd of October. And of course, we're kind of kicking off a new month as well, which means we finished the last month and we finished a quarter. So, I mean, beginning of new things in that sense. Will it be new for the market as well? Or will we continue to roll higher like we have? That's the question. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Hi, good morning. I realized looking at us, the colors, the blues, the pop, the flowers, it's all because the most important cue,
it's
Wednesday.
It's a truncated week.
It's a truncated week. But we have so much news to digest, right? So much going on around the Asian neighborhood. And then, of course, we have new entrants on the Nifty. So plenty to get us started on this Monday.
Oh, absolutely. And I think we start with what essentially came through over the weekend because, globally, the big talking point, of course, was the turn that the Chinese markets were seeing. And we saw a fair bit of action on Wednesday, Thursday, Friday. And it did not stop. Actions kept coming in on Saturday and Sunday as well. So I'll start there. So China has essentially announced more measures over the weekend. Authorities essentially have asked three things. Authorities have asked, in line with what the central bank there, the PBOC has said, they've asked all banks to cut mortgage rates by the 31st of October. One. Second, yesterday there was a meeting, the State Council, chaired by the Prime Minister, echoed what the President said, President Xi said. And specifically, they vowed to speed up 102 key investment projects. These are not new projects. They were announced in 2022, but they've said they'll speed it up. And three of the top sort of tier one cities in China, Shanghai, Guangzhou and Shenzhen, they've announced significant sort of property loosening policies, essentially making it easier to buy property, lesser down payment ratios, etc. So these are the three things which have come through over the weekend as we hit this new week, that is Monday. Now, what complicates the picture in a sense, right, is the fact that China is shut for most of this week. So from the 11th to the 7th, from the 1st to the 7th, which is Tuesday to essentially next Monday, China essentially goes into national holidays, the Golden Week, as it is called. Hong Kong is still trading. So, the China proxy in that sense, a lot of Chinese mainland shares are listed in Hong Kong. And foreign investors prefer to trade on the Hong Kong market rather than the mainland market. That market will be trading except Tuesday. Tuesday, Hong Kong markets are shut, but they're trading otherwise. So those are two things. This morning, if you looked at what's happening with Japan, you'd wonder, well, whoa, 4% cut. But the fact is that the Japanese market had shut by the time election results had come out on Friday. And, you got a new prime minister in place, and the market there is concerned about whether, he'll kind of want to normalize policy and what kind of policies will he really adopt? Fiscal conservative, will he be fiscally conservative, et cetera, et cetera. So the market futures, by the way, on Friday were down 6%. This morning, cash is down about 4% or so. So that's Japan as well. So a bit of Asia. I mean, nothing very much from the U.S. market on Friday. I mean, they were slightly down, but the Nasdaq was down 0.4%. Yields were here and there, but I mean, the dollar, I think, is what you should focus on. It's back in the support zone between 100.5 to 110.5 to 110.8. We are somewhere there, and a break below this. This is the, as we've said, 20 weekly and lows of 2023. You perhaps see a fresh leg down, and oil prices. There is this China stimulus, of course, this what's happened in the Middle East over the weekend and Lebanon specifically, and oil is right there. There's no big pop or anything of that sort. So that's interesting to note as well. Now, in the U.S., you've got a bunch of data points which are lined up, and I think it'll culminate with the non-farm payrolls number on Friday, and that'll be the big number to watch out for. I'll just circle back and finish up with the levels here. So that we're trading. On Friday, the indices were down. Nifty was down. Bank Nifty was down. So we had a daily negative close. But we were up about 1.5% for the week. So if you're wondering where the weakness is setting in, we are still trading above the 20 and the 40 hourly exponential moving average, simple and hourly exponential averages. So there is no sign of reversals yet as far as the indices are concerned. Now, we must stay above the 40-hourly exponential, which is 25,970. And as we keep climbing higher and higher, you got to be mindful of trailing reversal stops as well. And to my mind, from a very near-term perspective, that number is important to be held on to, 25,970. Now, on the upside, you basically have got to project targets, Fibonacci extensions, 26,521. We put this out earlier as well. We'll see when that happens. Nifty Bank, it closed around the 40-hourly exponential. Actually, we closed slightly below the 40-hourly exponential. We'll see if we stay below it. That's not good news. That is 53,841. We left off at 53,834. So just under that 40-hourly exponential. The supports here below the 40-hourly come in at 53,500 and then 52,900, and targets on the upside basically is the swing high, which is 54,460 or so. So that's essentially a quick picture. It's looking okay. Market's done quite a bit. Some consolidation would be nice. But the bigger question is, which many people are worried about, is whether, maybe too much is done and maybe there is a pullback due. And there you need to watch out for some of the levels that we put out, both on the Nifty and the Bank Nifty as well. Gift Nifty is indicating about a 60-odd point lower start. Surabhi.
Well, absolutely. Prashant, I guess it's all the headlines coming from Asia and two big markets moving in absolutely different directions. In fact, make that cut on Japan now almost 5%. That's the extent of the fall. And let's also pull up the dollar yen, because the currency markets had exhibited this nervousness on Friday itself, because the yen had leapt up almost 2% on Friday versus the dollar. Today, it's eased off a little bit, but nonetheless, I mean, it's still around that mark of 142 thereabouts. So what is the issue? Just a moment here. Shigeru Ishiba is the gentleman who has won the leadership of the current party that holds power in Japan, which is the Liberal Democratic Party. He was earlier the defense minister of the country. And he's seen as a bit of a hawk when it comes to monetary policy. And therefore, the market getting a little worried, the yen surging on Friday. But on the weekend, he made some comments to one of the telecasters, the national broadcasters, I think, in Japan, where he said that monetary policy must remain accommodative given the current economic conditions. And that gave at least the currency market some hope. But the nervousness is still very, very palpable in the equity market, as one can see. So that's the picture on Japan and how that's playing out. In China, the Hong Kong market continues to build on what was a tremendous week. There was a 13% rally in China. All put together in the month of September, the Hong Kong market is up 18%. I mean, no one comes close to that. And what we've got this morning is some fresh data. It's actually a pretty good data, manufacturing PMI. This is the official PMI number out of China. The contraction is reducing. So for the month of September, this official PMI is 49.8 versus 49.1 in August. So still contracting, but not as much. So that's the good news coming in. Speaking of data, I mean, the US market itself, usually September is a challenging month, but not this time around. It's the first time that the US, in all probability, today is the last trading day, will manage a positive September for the first time in 5 years. And the data that came in even on Friday, that continued to play out the Goldilocks scenario, because inflation, that's easing, and growth continues to be a little lackluster, you can say. So why do I say that? Look at the numbers. The PCE price index was up just 0.1% in August versus 0.2% in July. And the consumer spending number, which is the really important one to track in the US market, their consumer spending was up 0.2% in August versus 0.5% in July. So the consumer perhaps continuing to be, in a bit of a spot of bother. And that plays with the Goldilocks scenario. This is the situation on oil last week. This morning, there's a bit of a leg up on prices, around 72.5 on Brent. But whatever's happened overnight in terms of geopolitics, with the big headlines coming in, the Hezbollah chief Nasrallah being killed in those Israeli strikes, none of that has impacted the oil market, including the statement from Mr. Benjamin Netanyahu that Israel is not done. Because why? It's not impacting exact barrels in the market just yet. If anything, there's talk of Saudi Arabia increasing production, and that's keeping the oil market really well supported. So all things put together, the global backdrop is still very, very positive. Quickly coming back to cues here at home. Let's look at the fund flows. Foreign institutions, net sellers of around 1,200 crores, but massive, massive buying coming in from domestic institutions. Obviously, a lot of block trades as well there, but nearly 7,000 crores of buying coming through. In the month of September, it's the return of the large caps. That's the biggest trend that sort of stands out in our market action. Almost 4% up on the Nifty. Mid cap about 2%, and the small cap index is actually slightly negative. And right in step, we have two new Nifty members joining the index today. The rise and rise of Trent, the stock finally enters the Nifty, as does BEL, and of course, Divi's and LTI Mindtree go out. So it's all about the large caps. And we'll see if this trend continues in October, Nigel.
Well, that's right. For me, I'm watching 3 big points. And I believe that the buy on dips on the Nifty, that's intact till lower levels get taken off. So that's point number 1. The problem is, though, the gift Nifty is indicating a bit of a pullback today, maybe a 60-point downtick because geopolitical issues have crept back in. The good news is that crude oil prices are virtually unmoved. And point number 3 is, there's been that raging debate. China is bouncing back. Will it be a threat to India? Well, Kotak has put out a note. They believe that China may rally. It may so. But they don't believe it's a big threat to the Indian market rally because domestic flows are very, very strong and earnings as well is very, very strong. So those are the top 3 points. Let's move on to what happened in Friday's trading session. Why did we end lower? Because the Nifty Bank, that took a bit of a breather. That was down 550 points. But there was more unwinding of positions that we saw on the Nifty Bank itself. And I think in the near term, you want this 53,500 odd mark to hold out because the rally has been very, very ferocious. So the 20 DMA is much deeper. But that's the first line of support that you're looking at. What about the FIs? Well, the FIs, they added some long positions. There were some mild shorts that they covered out as well. They remain aggressively long with 81% of their positionings on the long side. The FIs, well, they're net long, 3.5 lakh contracts on the long side. You have the clients that are net short with 2.5 lakh contracts on the short side. Give and take everything. Let's pull up the options data. And this is a truncated week, so you only have a couple of trading sessions before these contracts expire. And normally you see, a bit of a short straddle that could possibly take place. And there appears there's a strategy in place. The 26,250 call and put, fair bit of open interest build up. You put it together. The premium you pocket is around 300 rupees. So you add 300 rupees to 26,250 and you deduct it from 26,250, which gives you the broad range that you're looking at. So this is the tightest range that we're looking at going by that option strategy. But it's going to be all about stock-specific action, right? So I'm looking at, a couple of them. One is the Flipkart sale. It saw a very, very good response. I was reading a CNBC-TV18 article on our digital platform today, and the response is very, very strong. So I'm looking at a couple of stocks, Delivery as well as Blue Dart. Logistic companies could be in focus, both these two. The other one I'm looking at is Reliance Infra. They've got a favorable verdict from the Kolkata, courts out there. They've ruled in favor of the company. And we're seeing that the stars are aligning for this one. Sunny people are talking about the assets that they have. They've got some infusion as well. And the 20 DMA is deep at around 260. So not a one for the faint-hearted, but Reliance Infra seems to have been getting its mojo back. So I'll keep an eye out on this one as well.
All right. Okay. So plenty to track as this week kicks off. Let's actually get you the equity call of the morning as well. Alexander Redmond of CLSA says China policy went into overdrive last week. He says the recalibration in scale and urgency of stimulus was applauded by investors, yet questions persist. Firstly, the motivation, he asks. Is this a quick fix for 5% GDP in 2024 or the beginning of a braver, more innovative solution for sustained growth? Secondly, on results, Alexander asks, will last week's initiatives be sufficient to break the deflationary deadlock by reigniting domestic demand? He says the answers will dictate whether the equity frenzy is the 5th bear market rally since March 2022 or something grander. He says they resisted underweighting China in the belief that the market offered the greatest self-help opportunity in the emerging market landscape. But for now, he says that they rent rather than buy the rally, staying benchmark and exposure larger than most funds. So that's the CLSA call coming in, still asking lots of questions on the durability of the stimulus.
Okay, well, so that's the view coming in from Alexander Redmond of CLSA. Ed Yardini is with us, president at Yardini Research. Ed, great to have you back on the program. Thank you for your time. Good to have you here. I mean, I think over the last 2-3 years, we've had, I think, 3 of these instances where we've talked about whether this is it with regards to China and the turn that and some of these measures that we're seeing. So we're at one of those moments again. The thing is, each of those rallies have been very large, between 40-50%. So actually you can be in it and then without having to worry whether this is because the moves are so large if you get in reasonably early. Do you think it's one of those, Ed? What's your sense?
I think it is one of those. I think it's to a large extent a technical rally. There was a tremendous amount of bearishness before the government of China acted to provide a lot of stimulus. And so there's a lot of short covering, obviously, and then expectations that it's going to work. I'm skeptical because I think at the end of the day, what China needs to do is stimulate consumer spending. And I don't think it's going to be that easy. I don't think offering lower mortgage rates is necessarily going to bring Chinese buyers back into the real estate market. Maybe it'll stop prices from falling. But at the same time, I think they're still going to have a significant residual negative wealth effect in real estate. Maybe the stock market rally will provide some positive wealth effect. But again, the market's down substantially over the past few years. And then there's the whole geriatric demographic profile as a result of the one-child policy. So I'm not convinced that this is going to do what China needs to do, which is stimulate consumption, stimulate more births, more family formation. But it probably sets a floor for now, anyways.
Mr. Yadni, hi, good morning. So
Morning.
what does this mean? What could it possibly mean for India, where investors anyway have been neutral? We're not even neutral. I mean, they've been underweight on this market. It's been a domestic-driven rally. And now you have these big moves out of China, the tactical move perhaps to that country. So what should we expect? Some more foreign selling here and then a shift in flows? Or would it be possible anyway as investors get back into emerging market funds where we have presence of both India and China?
Yeah, well, I think one of the key points here is that central banks, the major central banks, are pumping liquidity back into global financial markets. The U.S. cut the Fed funds rate by 50 basis points last week in the middle of the week. And by the end of the week, the Chinese were cutting their interest rates and reserve requirements. And so there's a lot of liquidity pouring back into the global financial markets. And that means that if China goes up, it doesn't mean that India has to go down. I think both markets could do well in a global melt-up situation. I think the Fed, by cutting 50 basis points in an economy that looks quite good, as a matter of fact, a lot of the numbers were revised higher for GDP and for personal savings on Friday. And so the U.S. economy looks pretty good, and you kind of scratch your head wondering, why is the Fed so rushing to lower interest rates here? Well, all that liquidity is going to create the potential for a melt-up. Look, I've been thinking the S&P 500 could hit 5,800 by the end of the year. Well, we might get there tomorrow or the next day, the way things have been going. And valuation multiples are awfully high. So I think we're in a melt-up situation on a global basis.
All right. Hi, Ed. Morning and good to see you, Win. What does it mean for an Indian market, though? We have been big outperformers. We're not trading cheap. And suddenly you have the Chinese market coming back into play. And they are also going to deliver double-digit growth, but we are going to deliver high teens. The toss-up between the two in the near term, as you said, both could do well. But in the near term, do you think there'll be a tactical shift towards China?
Well, I think there's so much money sloshing around in the global financial markets that I think it's really conceivable that China might continue to rally here on the hopes that the stimulus will turn their economy around. And yet there'll be plenty of money left to continue to invest in India. So I don't think it's a zero-sum game. I think what we're seeing here is that central banks have basically brought back the everything rally. We're seeing stocks going up. We're seeing copper going up, gold going up, Bitcoin going up. So all that liquidity suggests risk on, and it suggests that central bankers are back to their old game of probably providing way too much liquidity.
All right, Ed, we leave it there. Thank you very much for your time. Great speaking with you. So I think the answer is too much money sloshing around, right? So that's lifting most things, most boats, and that is absolutely correct. Central banks have just about opened with rate cuts, and the Fed has done it, and China has done it, and perhaps others will follow as well. We'll take a quick commercial break here. The first on the program, just a quick tease out of our stocks that you'll hear on the other side. GAIL, Zydus Life, Olympic Pharma, Piramal Pharma, Keynes Tech, Wellspun Enterprises are stocks which perhaps should open up in the green on the back of news flow. Biocon, Lupin, Angel One, 5 Paisa are some of the stocks which perhaps open in the red. So that's coming up with our research team. Stay with us.
Okay, let's tell you the corporate interactions that are lined up on the show today. Well, coming up at 8:30, we have the management of PB Fintech joining in to talk about the company's potential plans into the healthcare segment. At 9 a.m., we'll have the management of KC International join in to talk about their recent equity fundraise. They've done a QIP recently, and of course, a bunch of order wins have come through. So we get chatting with Mr. Vimal Kejriwal. At 9:20, Pankaj Tibrewal of Ikigai Asset Management joins in, and he's the market master, so he gives us some perspective on how we're poised. At 9:30, we chat with Aadhar Housing Finance to decode the outlook and the way forward for the housing sector.
Okay, we'll also have, expert joining us to discuss how the impact of exchanges increasing, a trading fee. So Rajesh Palviya will be with us to help us with that. And a little later, after that, at 9:50, the management of Zentech will join in to talk about, the implications for their business because of the new weapon system. Towards the end of the program, Lata will be in conversation with Ashish Agarwal of NASSCOM and Megha Chavla of Bain and Company. That's later at 10:15.
Okay, all right. Well, time to slip into a short break. On the other side, we'll address all the top stocks that we're tracking for you. Don't go anywhere.
Welcome back. Lots of stocks to track as Monday kicks off. Let's straight away get down to the CNBC TV18 list of top stocks to watch. Our team is standing by with all the action. Guys, good morning to all of you. Sonal, let's kick it off. Why are you watching out for GAIL today?
Well, GAIL is in focus because they have updated the exchanges that two of their major pipelines, those will see a delay in completion or at least commencement of their operations. The first one is the Srikakulam-Angul pipeline, which was supposed to start in September 2024, will start in June 2025 now. And there are three more pipelines. The names are there for you on the screen. Instead of starting on 31st October, they will be starting on 30th June 2025. The company says there are a number of reasons. The bigger reason being they have not received approvals at various state levels or local authorities, and that's the reason they are not able to go ahead with the completion in time. While GAIL's work on the side of construction is mostly done, they are waiting for approvals now.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Ekta. She's here to tell us about some of those pharma stocks. Ekta, morning.
Morning. Well, I'll start with a couple of stocks. Actually, a lot of news with regards to the US FDA and inspections being completed in the past 2 days. So Alembic, for example, will be in focus because they've received an establishment inspection report for the oral solid facility. The inspection was for 17 July to 26 July. So the stock should be in the green on account of that. Biocon, I expect the stock to probably be in the red because they've got two facilities that have been inspected. The US FDA issued 4 observations to the API facility in Bangalore, which was inspected in September. And the companies issued 5 observations across their drug substance facility, which is in Malaysia, which manufactures insulin, and 3 observations in a separate facility in the insulin manufacturing facility in Malaysia. So totally 8 observations is what they've got for the insulin manufacturing facility in Malaysia, but in 2 separate units. So that's important to note. Piramal Pharma, companies received an EIR for their facility in Ahmedabad, and Zydus, they've received a US FDA nod for a drug which is used for cancer patients with prostate cancer. It will be manufactured in Moraya, the Ahmedabad facility. Size of the drug is quite big, $869.4 million.
All right, Ekta, thank you very much for that. Well, more stocks with news flow. Vamakshi is here. Vamakshi, morning.
Well, good morning, Prashant. Let me first start off with Keynes Tech. Expect the stock to open in the green, and that is because the board has entered into a share purchase agreement to acquire 100% stake in Iskra Meco India Private Limited for a total consideration of around 43 crores, which pegs this deal at a valuation of that is the price to sale at 0.66 times based on the FY24 revenue of the company. Keep in mind that Iskra Meco India is engaged in supply, installation, operations and maintenance of smart meters in India, and this in turn will enable Keynes to increase its product line and service offerings. Apart from that, keep an eye out on Welspun Enterprises as well, and that is because it has been declared as an L1 bidder by the BMC for a project worth 1,990 odd crores. This is to design and construct tertiary treated water conveyance tunnel from a wastewater treatment facility in Dharavi to another one in Ghatkopar. Apart from that, keep an eye out on Angel 1 and 5 Paisa Capital, and that is because NSE and BSE have updated their transaction charges to comply with SEBI's circular, which was issued on July 1st. The SEBI circular directed MIIs, that is market infrastructure institutions, to discontinue the practice of levying slab-wise fee structures, which was dependent mainly on volumes of the trading members. And instead of that, the circular has directed MIIs to now follow a fee structure that is uniform and equal for all of its members. Overall, this announcement is expected to be negative for discount brokers like Angel One, 5 Paisa, and that is because under the earlier slab-wise regime, these brokers would pocket the difference between the transaction charges charged to a client, which were generally higher, and the applicable transaction charges that were payable to the exchanges, which were generally lower on account of their high volumes. The estimated impact on brokers' revenue was also stated. Angel One believes that an 8% impact could come in on the revenues, as they had told us back in July 2024. So given those factors, going with the red for Angel One as well as 5 Paisa.
Okay, got it, Vamakshi. Thanks very much. We'll watch out for these stocks as well. Let's quickly recap the list for this morning. Stocks that have positive news flow around them are Gale, Zydus Life, Alembic Pharma, Piramal Pharma, Keynes Technologies and Wellspun Enterprises, while stocks with negative news are Biocon, Lupin, Angel One and 5 Paisa Capital. Okay, let's look at what's happening in the world of commodities. Lots of geopolitical headlines coming in over the weekend, but they haven't moved oil prices much. Manisha is here with the latest. Good morning, Manisha.
Morning, Sylvie. Thank you for that. Well, yes, the crude oil prices actually fell 3% in the previous week, but we are looking at some buying in the Asian markets right now. Well, the Israel stepping up attacks on Iran-backed forces, also China stimulus, and then you have the Hurricane Helen also forcing 25% of output in Gulf of Mexico shut are some supportive factors here. But yes, it's not a runaway rally. The rally is what we've seen has been in case of the metal prices. So when you look at the week-on-week and a month-on-month gains, the metal prices clearly seem to be outperforming there. China has put the most aggressive stimulus since pandemic, and that has been supportive. So we've seen copper prices give you the best weekly gain in 4 months. Nickel is trading at a 1-month high. Silver prices in the previous week hit a 12-year highs as well, while the markets seem to have seen some profit taking by Friday evening, but Asia yet again is trading in the positive. And this week you have the US Fed chair speech, PMI data, and a whole host of data coming in from Europe and China as well, and the markets would be reacting to that.
All right, Manisha, thank you very much for that. So lots to track, and that's commodities in focus. We're going to take a very quick commercial break here. We're going to come back and we'll have the management of PB Fintech and we'll discuss the news flow around PB Fintech. Are they entering the healthcare space, and what shape, form will there be investments required? Yashish Dahiya, Chairman and Group CEO at PB Fintech, and Alok Bansal, Co-founder and Executive Vice Chairman at the company, join in to take us through some of that thought process. Stay with us.
Welcome back. Let's straight away get this conversation going with PB Fintech. The company has been in the news of late because there's been a fair amount of chatter on whether they are looking at a full-blown healthcare foray, and if yes, then what is the shape and form that this foray could perhaps take. We have with us Yashish Dahiya, Chairman and Group CEO at PB Fintech, and Alok Bansal, the co-founder and Executive VC at the company as well. Gentlemen, thanks for joining in. Yashish, morning. Let me just, take the straight question, the elephant in the room. Describe to us, when you say we want to enter the healthcare space for improving customer experience, what does that mean? What is this network that you're looking to build? And also the critical question from a market perspective is, are you going to start building hospitals or buying hospitals? Because that involves a lot of cash and that becomes an asset-heavy business model. What are you thinking?
Yeah, first of all, let's just clarify one thing. PB Fintech is looking to make an investment subject to board approval in a separate venture, which actually is not a PB Fintech subsidiary. PB Fintech would probably be a minority investor between 20 to 35% equity holding, right? And this venture, for lack of a better word, let's just call it XYZ. XYZ has its own life beyond that, and PB Fintech's liability is limited to that first investment. It does not have any compulsion to keep investing into the future, right? And all this is subject to board approval. Now, what is XYZ wanting to do? And what is PB Fintech's interest in XYZ, right? XYZ just looks bad, so let's just call it, well, let's keep calling it XYZ. So XYZ wants to build an HMO. What is an HMO? HMO is an outsourced facility of hospitals which is aligned to the insurance industry. Today, 4 crore 40 million Indians are buying health insurance, and they pay about 10,000 rupees every year to the insurance industry for this, which is about 40,000 crore rupees. And they say, look, whenever any of us 4 crore fall ill, you take care of our expenses. When they go for these expenses, they have something called a claim. And in that claim, there is a lot of pull and push. Why is there pull and push? Because there is a lack of trust between the insurance company, the hospital, and the customer. And one of the ways to align for this lack, what is the lack of trust, right? Insurance companies feel this treatment may or may not have been required. This was an over-hospitalization. This was an overcharge. This particular cost should not be included. Now, at the same time, healthcare costs have been rising. ARPOPs have been going up. ARPOPs have increased by 40 to 50% in the last 5-6 years. And that is not something that eventually who has to pay for it, either the customer or the insurance company. So an ARPOP increasing is great for the profitability of the hospital, but an ARPOP increasing is not great for the insurance industry or for the customer for that matter. So this is a big pain point of conflict. And what this does for the customer is creates...
Yashish, hi, morning. Morning. You know, I will just come to some of the details in just a bit, but you gave us the headline straight up. You said that PB Fintech, essentially you're incubating a separate company and you are going to put in...
We are not even incubating. We are not even incubating.
It's going to be a separate company in which
altogether.
PB Fintech will have 25 to 30%, possibly subject to board approval.
Yes.
Okay, 20 to 30%, subject to board approval, and I'm assuming subject to shareholder approval as well, right? At some point. Could you tell us what is the investment that you're looking to make?
It might be somewhere between $0 to $100 million.
$0 to $100 million. And you're saying that it's not necessary that after that initial investment...
It's a one-time investment. Okay. It is not a recurring investment.
But after that, will there be some sort of assurance that you will not put in more money to work?
After there is neither assurance that way, nor is there an assurance that we will keep putting money, right?
Okay.
The intent is not to have a recurring investment. The intent is you put in the money first time, and after that, the company has its own corporate governance and its own objective to carry on. And whether that company does an IPO, whether that company raises money, think about it. When InfoEdge invested 20 crore rupees with us, the maximum InfoEdge could have lost is 20 crore rupees. InfoEdge did not have any obligation to carry on investing. After that, Intel Capital came, then, Inventors came, and then Tiger Capital came. But InfoEdge did not have the obligation to keep investing with us. And
okay.
I completely was not getting into the insurance distribution business.
No, I completely agree. And I want you to explain this HMO as well, but just the basic hygiene details, if you can. Will it be north of $50 million? Will it be closer to 100? I mean, some sense.
We don't know right now. It's 0 to 100. PB Fintech might prefer it to be 0. But if an industry utility is being created, PB Fintech is interested in an industry utility doing well, it may invest up to $100 million. But that's the broad range. And that too is subject to board approval, right? It's not like management can go and do it on their own.
Okay. Just a question. Yashish, you said obviously it's all subject to board approval. When do you take it to the board?
We're not in that stage yet. See, you guys and, I think ET basically broke the story somehow. But we are not in that stage when we are going to the board kind of tomorrow or anything of that sort.
No, but I understand, but that's why this conversation is really helpful, so that investors exactly know what's the thought process, and it will take its own due process. I mean, board approval, etc.
I would say that time frame is perhaps quarters, not years.
Okay.
But yeah, it's quarters. It's not weeks.
In this year? In this year, this financial year, or the next?
How do I know? It depends on where the other partners also get together, right? It's when that company says, I'm ready, I have finalized all my investors, and now is PB Fintech ready, is when we would have to take it to the board. We can't take it to the board till that company, XYZ, tells us that I am ready with all my other partners. And
fair.
we may now invest.
Fair point.
It's not something we can control.
No, fair point. Absolutely. So, which is why let's go back to the original point that you were making. Now, we've understood that PB Fintech will only invest 20 to 30%. I mean, that's the extent of the stake, and it could be the cap is 100 million. That's what you've kept in mind, at least as of now. We've understood that. Now, let's look at the contours of this new healthcare company that you're speaking of. Apart from PB Fintech, who are the other, potential, co-founders? How is this going to be set up? And again, what's the strategy? Not buying hospitals, setting up hospitals, working with a network of hospitals. What's the model? And has this been done anywhere before?
No, sure. So the model is essentially an HMO model. And this entity is obviously finalizing with its other investors and other partners. They could be healthcare companies, they could be insurance companies, they could be development finance institutions, they could be private equity players. There's a whole bunch of people that it will speak to. Now, what is this entity trying to do? It is basically saying for the 4 crore people who buy insurance, I want to give a hassle-free experience. They should not interact with 2 words, bill and claim. They should come to me for getting treated, get treated, and go home. And it's my job to make sure they stay healthy. So I would probably overinvest a bit in their wellness, in their care, in their post-hospitalization treatment, so that their chances of falling in and coming back to hospital are the lowest. Please appreciate. No, it's a very important thing I'm trying to say. This entity actually makes more money if its hospitals are empty. And I think that is where people have not understood what this entity is trying to do.
Exactly. So yeah, absolutely. Let's also bring in Alok. He's been patiently listening to us, quizzing you. Alok, that's exactly what we need to understand, that this new, and it sounds actually almost too good to be true, right? Because as Yashish very rightly described, up until now, the interests of a hospital company and the patient or the insurance company have been at odds. That's the way the model works. The hospital wants to maximize profits and the insurance company or the patient wants to minimize cost. You are looking at setting up this new company, which is going to bridge the gap. How is that even possible? And again, who are the other investors or potential like-minded sort of people who will come together with you on this foray?
Here, Yashish mentioned there are 2 parts, right? One part is whether it's good for the insurance industry or bad for the insurance industry. And if it's good for the insurance industry, it's good for Policybazaar or PB Fintech as well, right? So there's a part which I think we have explained enough in the last 5 minutes. Now, coming to this particular venture, there are 2 parts. One is the asset part, which is the hard part in terms of hospital, land, building, whatever. And the second is the operation and management part of this, which actually controls the customer experience. Our interest and the industry interest actually is to manage that O&M part. If you manage the O&M part, asset can be owned by anyone. If you look at a lot of examples from manufacturing across the world or hotel industry from across the world, you don't need to own those assets. You need to own the experience. Now, when it comes to...
But the asset owners, Alok, but whoever is the asset owner, you might be renting the asset, I get that, and this is just an operation manager. Whoever is the asset owner, they will want the highest ARPOB. At the end of the day, they'll demand from this company, right?
No. So this is not asset owner in terms of hospital, right? This is asset owner in terms of... Just think of Taj Hotels managing some hotels which are owned by someone else but managed by Taj. Or Apple getting someone to create a phone for them, where they manage the design, they manage the marketing, they manage the brand, but someone is creating that phone for them. They're manufacturing the phone for them. So the person who is owning the asset has a very different alignment. A person who is managing the experience has a very different alignment. Now, in this particular case, the investment is going into an entity, or it's proposed to go into an entity, which will eventually own the experience. But to get there, you can't have on the day one that, okay, I'll manage the experience, but someone owns the asset. Just think of how McDonald's would have started. They would have created few their own units and then got into franchisee model, right? So you have to start somewhere. You have to do the POC, and once you have done the POC, then asset can be owned by anyone.
No, absolutely. I had a couple of questions and we're running out of time. So very briefly, Yashish, will this be a conflict with other hospitals?
We are not even thinking about that. This hospital is going to be aligned to the insurance industry. We are not really thinking about what it does to the other hospitals. I do believe it will, if successful, set benchmarks for the others, because today people can argue that, listen, costs are just going up, we can't manage them. But if one entity is able to reverse that, then an argument gets created that, hey, it's possible, so why can't you?
But if
interests are misaligned.
Got it. But if this drives sort of footfalls to a certain network of hospitals, I mean, will hospitals outside of this network, obviously they won't like it. I'm saying that does this in any way hamper your core business?
In India, there is enough demand for for healthcare. I don't think that is the challenge, and I think everybody has their own market. This is meant for middle class India. That middle class person cannot afford 78,000 per room night. Let's be very clear.
Got it. Absolutely, absolutely. I mean, we can barely afford. And I completely agree. And we are middle class India. Yashish, just a quick point. Does this XYZ entity already exist, or this is to be created? I mean, this is yet to come up.
No, this XYZ is yet to be created.
Okay, and this will require this entire thing will require shareholder approval as well, or no? Just board approval?
No, it will not require shareholder approval. It's a minority investment, which is what our IPO funds were raised for and have been allocated, have been earmarked for that already.
Got it. We'll leave it there, gentlemen. You know, great to have both of you and really coming out and talking to us about this. Appreciate your time here on CNBC-TV18. Mr. Dahiya, Mr. Bansal, really great speaking with the both of you. You know, we're going to take a quick commercial break here. That's PB Fintech for you, as you heard it. I think we have Prakash Devan now joining in with what he's making of the markets. But I think, Prakash, good to see you again. You heard the conversation with PB Fintech. Your first thoughts? You're on mute, Prakash.
So what I was saying is, Prashant, it's a very noble cause. Great to have something like this come into the ecosystem, but it's too early to even figure out how it's going to impact, what is going to be the exact quantum of impact. So I think you'll have to wait for that XYZ company to be formed, what valuations PB Fintech allocates money to it, and things like that. So too early to really make any conjecture, but yeah, I mean, it does look like they finally want to get into something to diversify their business model in terms of the risk from just insurance selling.
Okay, all right. Hi, Prakash. Good morning and good to see you. It was good to meet you yesterday as well at that event, and the equity cult here in India is well and truly, developing. So that was good to see the kind of feedback we saw. But a quick question on China. We're having a melt up in metal prices. Iron ore prices are up 5-6% as we speak. What do you like from that space?
So good morning, Nigel. Yeah, so I think out of the metal mining companies, you would rather stick to the bigger ones. And from that perspective, NMDC continues to offer great value. As I said last time, you probably have a revival of some of the sleepier ones like the OMDCs and the MOILs of the world. I've been positive on MOIL since quite some time. It's delivered from there on. But I think there's a reset that's, again, imminent. Importantly, what's going to happen is everybody is a bit doubtful and skeptical about whether the stimulus is going to have a long-term impact or how long-term the impact would be. And once that happens, you'll probably see the mining companies and metal, suppliers, their underlying derivatives. And don't miss out on the graphite players. I think globally, and you track this so well, so you would know, I think the HEGs of the world will also start getting their place under the sun very soon, if not yet. And that's the space to kind of look at. We spoke about refractories, we spoke about the mining companies, but I think the graphite plays also could start looking up. But, principally, steel is where all the focus and attention is. It could be a bit of a journey which has some volatility, but stick to the larger ones like SAIL, JSPL, and I don't think you'll go wrong.
Okay, all right. Prakash, request you to stay with us for a bit. We have Anuj who joins us to help us out with how he's seeing trade setup today. Morning, Anuj.
Morning, Nigel. It reminds you of that famous Amir Khan dialogue, Jana tha Japan, pahunch gaye Cheen. So today we have both Japan and China in focus, and my sense is you want to focus more on China and less on Japan. For starters, of course, it's a crucial day because the first Monday of a new series, and normally that is crucial because you keep an eye on some markers. Two important boundaries, 25,998, the expiry day low, and 26,277, the prevailing all-time high. I mean, if you break 25,998, then it could trigger a fall, and if you cross 26,277, then you're set for a bigger rally to 26,500, 26,800. And if the gift nifty is right, we'll start somewhere in the middle of these two markers. As I said, instead of Japan, focus on news coming out of China because that's positive for us, for some of our stocks. Friday's other big talking point was Bank Nifty. That's something to focus on. There was a 500-point decline on Bank Nifty. And there's some chatter about a possible double top on HDFC Bank, somewhere around that 1800 mark. Let's see. For the fresh rally now, HDFC Bank needs to cross that 1800 mark. Also, IT will be in focus because you'll be starting the earnings season from the second half of next week. In terms of stocks, metals is something that you could focus on once again because of the fresh stimulus measures that you have from China. And lastly, I'm focusing on what the three big indices have done this month and this year. I mean, what you can say is Nifty is the more consistent performer, 3.7% this month and 20% this year. Nifty Bank this month has outperformed, but this year has underperformed. Nifty IT this month's underperformer, but this year's outperformer. So clearly, Nifty slightly better placed. The Nifty IT is at make or break level around the 20-day exponential moving average, and Nifty Bank has been outperforming, but Friday's decline was big. So you got to give it some importance. Let's leave you with the quote of the day, and since it's Monday, it's a bit more motivational. If we have the attitude that it's going to be a great day, it usually is.
It's going to be a great day.
It's going to be a great day, yes.
Thanks a lot, Anuj, for giving us straight setup as well as that thought as well. Well, for the time being, I'll tell you what, we'll take a snappy break. We come back, we'll continue our chat with Prakash. We'll also get in our technical experts. Don't go anywhere.
China, China, China. I think that's the sort of chorus out there. The Chinese markets are up 4% right now. As we speak, Hang Seng is up a little less, but it's up and has been, from the lows of September, quite a remarkable 25% kind of a move that we've seen. We've got Andrew Tilton, a Chief Asia-Pacific Economist at Goldman Sachs, joining us. Andrew, great to have you with us here on the program. Thanks for your time. Prashant, this side. Andrew, is this a big tactical move? We've had at least two of these since 2020, which eventually does not go anywhere. But when you're in it, it feels like the real thing. 40, 50% kind of moves from the lows. Are we in the midst of one of those, or do you think this time it's different?
Sure looks that way. We've seen a big shift in Chinese macro policy over the last week. Investors have been waiting for quite some time for signs that policymakers would take more decisive actions to stem the housing downturn and try to stabilize growth. Last week, we had a PBOC announcement with a bunch of monetary policy easing measures, and then a Politburo meeting indicating the willingness to deploy more fiscal stimulus. So those are very important signals that I think markets have been waiting for a long time.
Hi, Andrew. Morning, and good to see you, Ben. But do you think the Chinese authorities have done enough? Because in the past we have seen the announcement come about, the excitement as well, heats up, but ultimately it fades away. But this time, do you believe they've done enough?
We know a lot about the monetary stimulus. We've eased policy rates 20 basis points, cut reserve requirements half a point, taken some measures to boost the equity market as well as housing. What we don't know as much about yet is the fiscal stimulus. There have been various media articles suggesting potentially bank recapitalization, consumer-related stimulus, but the details of those fiscal measures are not yet available. So I think it's too early to say they've done enough. We'd likely need fiscal stimulus in the trillions of renminbi to really move the needle in a significant way on the Chinese economy. There are big structural challenges, a multi-year housing downturn, cautious attitude from both consumers and businesses. And so to turn that around and really improve the growth outlook for 2025, we're going to need to see a big dose of fiscal stimulus, and we're still awaiting the details of that.
So, Andrew, we have major moves happening in two large economies, right? There's China on one hand. Tell us, to sum it all, whether you think this will really move the needle. We just had the latest official PMI numbers out this morning. They're not as bad as what we've seen earlier this year. So, all things put together, where does it leave China? Is it getting out of the funk? And then there's Japan, where there's leadership change, where there's a question mark on whether BOJ will keep hiking, whether they'll pause because the Fed is cutting. What should we expect from Japan over the next 6 months?
Well, these two countries are really going in very different directions with regard to policy. Japan is tightening, albeit slowly, and from a very easy level, tightening monetary policy. and potentially fiscal policy with the new PM, talking about potential tax changes, whereas China is going the other direction, easing monetary policy, potentially easing fiscal policy quite significantly. And I think you've seen the equity markets respond accordingly, with Japan down, China up. But the bigger lens I'd put on all this is we are seeing an opening up of space for a lot of central banks around the world to cut rates. The Fed has begun cutting with a 50 basis point move in mid-September. A lot of emerging market central banks that were on the fence, maybe waiting to think about cutting rates, are now feeling more free to do so. The U.S. dollar has weakened. Those capital outflow pressures, particularly from China, have eased, and that's opened up policy space. So you remove some of those constraints on policymakers, and in a place like China, where growth data have really been disappointing, that provides a better backdrop for policy easing, which is what we're beginning to see.
Andrew, you said, right, it's not monetary. It's exactly what they do on the fiscal side which will matter. And there was a Reuters article which essentially said that they're planning to, in dollar terms, about $120 odd dollars per child, per household. I mean, something like that. That's essentially what they said. Direct money, cash transfers is what that article suggested. Is that going to be? Is that what is going to be needed for markets to remain excited? I mean, real economy we'll get to when it happens, but what will it take for markets to continue to do well?
That will be a shift from what we've typically seen Chinese policymakers do in the past. Typically, they've used fiscal stimulus to support infrastructure spending, government priorities, sometimes trade-in allowances to encourage households to move up to more green or newer appliances and cars. Direct cash transfers have typically only been done in very small size. So a larger scale cash transfer would be a signal that policymakers see the concern around the economy and are willing to do more. Just to put it in perspective, we think the monetary easing measures taken last week would be worth a bit less than a half point on Chinese growth. Now, 1 trillion renminbi, which I think is the stimulus to which you're referring, on the consumer side, if that were implemented, that adds up to 80 basis points, so 0.8 of a point of Chinese GDP. Not all that money would necessarily be spent, but again, you could be talking about an impact on the order of potentially half a point of Chinese GDP. There are other tailwinds. The housing market continues to slide, and exports, which have been very strong over the past year, probably won't be quite as strong in 2025. So there are a lot of moving parts, but as the external side of the economy, which has really been supporting growth, starts to fade, policymakers will need to do more to support domestic demand, particularly consumption.
All right, Andrew, we'll leave it there. Thank you very much for your time. And I hope that we can sort of, you'll come back and we can sort of track this progress and what's happening in China with you on a regular basis. We'd love to do that. Thank you for joining us here on CNBC-TV18. We'll take a quick commercial break here. We'll have Mitesh and Sudarshan on the other side with their technical trading ideas. Stay tuned.
Welcome back. Hope you're having a good morning. As promised, our technical experts are with us. Mitesh Thakkar and Sudarshan Sukhani join us on the show. Good morning, gentlemen, and good to see you. And as always, Mitesh, you go first. Tell us, how do you approach trade today?
Good morning, Nigel. Today, I think the GIFT Nifty is indicating a mildly negative start, and my buying zone or my support areas on the charts which I would want to enter at is one closer to 25,970 and then 25,800. So while the immediate decline may not give you an entry opportunity, I think during the day, if we come closer to about 26,050, 60 odd levels, I would want to start taking some long positions on the index and keeping a stop below 25,970. Maybe add aggressively in case we get closer to about 26,000, 26,020 as well. So it's a buy on dips kind of a market for me. It is still a positively trending market for me. But yes, you can have a few days of pullback in between. And I think maybe today, in the worst case scenario, till tomorrow noon, we can have some kind of a pullback.
Okay, got it. Sudarshan, hi, morning. What about you? How are you approaching the market today?
Good morning. Well, on Thursday, I had suggested taking profits, and we had a big rally that day. Ideal location to exit long positions. My view continues to be that the market will be choppy and sideways. Now, there's a strong possibility. Actually, the market can be anything. But my sense is that the probability is that we will be choppy and sideways. It's not going to be fun taking a long position in this environment. And we don't know the lower levels to which this market can go if it does that. So the trade is, do not take any trades in the Nifty and the Bank Nifty, focus on stocks.
Let's get to the stocks then, Sudarshan. Tell us what is on your radar.
Well, a lot of mid-cap stocks are moving up and giving buy on dip opportunities. But I'll start with a large cap, that is Reliance. Reliance has just broken out of a small consolidation. So the chances are that while Reliance can outperform and push the Nifty up, some other sectors like banks and IT could push it down. And therefore, the Nifty could be choppy while Reliance could be an outperformer. So buy Reliance with a stop under 29.34. Buy Hind Petro with a stop under 403. Grasim is a buy with a stop under 26.49. And finally, Chambal Fertilizers, which is also breaking out of a consolidation, is a buying opportunity with a stop under 484.
Got it. And Mitesh, what about you?
I have some conditional buys. Ambuja Cement is something, which gave a good move on Friday. And if it can clear 636, 640 band, I think it will give a short-term trend reversal signal. So the trade would be buy about 640, keep a stop at 629. Look for a target in range of 670 to about 675. Buy on BPCL, which was a recommendation on Friday as well, did extremely well. Should see some more continuation. So BPCL is a buy with a stop at 360 for targets of 380. One sell, City Union Bank, keep a stop at 166, look for targets of 155. While Canara Bank on a mild decline, let's say a rupee or rupee and a half decline, around 112, 111. Canara Bank is a buy call for me with a stop at 108.5 for targets of 119.
All right, we'll speak with you again soon, Prakash, Mitesh and Sudarshan. Thanks very much for that. Prakash is still with us. Prakash, just a quick word on, if you will, the oil marketing companies. I think we had a technical trade there. Stocks were up 6% on BPCL on Friday, and that basically is, the story is the big drop in oil. This morning the story is oil is unmoved despite all the geopolitical escalation, China stimulus. Both actually should push prices higher, but nothing. 72. So just your thoughts on that, Pak.
No, so absolutely. So let me echo the view that I had even last week when we spoke about this. And BPCL is the one that I'd spoken about as probably well poised out of the three, given that it has a very fair balance of marketing and refining. Right? Unlike IOC, which is more skewed towards refining, HPCL more skewed towards marketing. And Prashant, the crisis released not impacting oil, Saudi still, wanting to kind of keep upping the output is a very clear indication that oil is going to be range bound and probably biased towards the lower side. So if that were to happen, of course, that's an assumption and it could go wrong if some events happen which we don't know which could anticipate it, could be out of the anticipated move. But my sense is oil marketing companies will still benefit because they offer the best value. In fact, BPCL is probably one of the lowest valued stock in the Nifty as of now, if I'm not wrong.
Oopsie.
I think we lost the line.
Okay, all right. I think that line has snapped over there. But we'll thank Prakash on that note for joining in and giving us his insights into a whole host of stocks. Well, the next one we're looking at is KC International. Remember, the company has got a tailwind because we have the National Electricity Plan that was announced last week, and that's a tailwind for the industry itself. But to get more company specific, they raised some money via the QIP route, around 850 crores or thereabouts. To understand what they'll use it for, what's the way ahead, we're joined by Mr. Vimal Kejriwal, the MD and CEO of the company. Hi, Mr. Kejriwal. Good morning. Always good having you on the show. Break it up for us. This money that you've raised, you've mentioned that some debt repayment will take place. So how does it, deleverage your books? Point number one. And point number two is you're taking an enabling resolution for around 4,500 crores. So is there further equity fundraise that's due in the coming months?
Morning, Nigel. As far as the QIP is concerned, we have raised around 870 crores. And the primary purpose is debt deleveraging. Almost everything will go towards debt repayment. We have kept some small amount towards general corporate purpose, I think 20-25 crores. So large purpose is to strengthen the balance sheet. And the impact of that is that, our debt equity, which was expected to be around 1 at the end of the year, will now probably be around 0.7%. Similarly, debt to EBITDA will improve by around 30 basis points. And if you look at the overall impact on the balance sheet for an annualized 870 crores would mean around 75-80 crores of interest cost saving. And secondly, since we'll be repaying some of the debt, etc., it gives us a lot more room to use non-funded limits, so we can raise some more bank guarantees and LCs, which will help us in growing the business a little more than what we could have grown otherwise.
But hi, morning, Mr. Kejriwal. Got that point. But the thing is, I think originally the enabling resolution was for a much larger amount. I think 4,500 crores, and that got the market excited about potential inorganic moves or maybe acquisitions that you'll look at doing, and then eventually you raised only 870. So what is the thought process? And I mean, the buzz is on ITD cementation, whether you were interested, whether you've pulled out, what the issues there were, and if not ITD, any other company. But again, the QIP amount now doesn't seem to suggest that you're looking at any immediate mega acquisition. But just set the record straight on this.
Yeah, so good morning. I lost you for some time, but I think the question was, you've got a enabling for 4,500 and you've done a lesser amount. So I think it's very clear that when we had raised the QIP also, which was enabling resolution, we had very clearly mentioned that a part of this, which was close to 800 or 900 crores, would be used for balance sheet strengthening. And the second one was enabling to keep us, ready with a sort of a war chest or thing. And when we get a good acquisition or multiple acquisitions. So right now we are looking at quite a few of them, but I don't think anything is something which will happen today or tomorrow. So we do have an option of raising more money, but I think it will happen as and when we get something.
So the war chest, basically the war is not fully on, I guess. But I was asking you about ITD cementation. Are you completely away from that particular potential asset? Have you lost interest there?
So I don't think I would like to comment on an individual asset. Okay. We have quite a few of them in the pipeline. Some of them are in the civil side. Some of them are on the oil and gas, etc. So I think we will have to wait and watch what happens, how it develops.
Right. Mr. Kejriwal, I would not normally push you. Good morning, Prashant here. But, our colleague Yash had reported on the 1st of August that you are the front runner to acquire the promoter stake in ITD. So just for the sake of clarification for our viewers, are you still in the race or are you no longer in the race for that asset and you could be looking at others?
Prashant, I will unfortunately not be able to comment on individual assets. Okay. And that's what we had said earlier also.
Okay. No problem.
Okay, all right. Got it. So in case you're going to be doing some inorganic growth, only then will you come to raise some money? Is that the way we look at it?
100%.
Okay, all right. Got that. There's a ratings downgrade that's coming from CARE. Give us further clarity on that. Was there any, any payments that you missed, or if you could give us some clarity on that front?
So, Nigel, there was no payment missed or anything. If you read the rating rationale, the rationale is all positive, except that they said that the gross current assets should have come down more than what they have come down, and that's the single biggest reason why they decided to downgrade. And they have also mentioned the QIP. Our request to them was that we should wait for the QIP to happen. But anyway, the rating committee decided that they cannot wait for that to happen. Now that we have done the rating, the QIP, we will go back to them. There was no other reason. There's no miss or anything. We have been absolutely on dot on all our payments.
We take your point on that, Mr. Kejriwal, and appreciate you joining in, giving us details with regard to that QIP. Most of it will be used for debt reduction. You're fairly comfortable with regard to the leverage in your books, and only in case you're going to be doing an inorganic growth will you come ahead and raise further capital from the markets. We look forward to chatting up with you in the time to come. Thanks a lot, Mr. Kejriwal. Well, let's go back to Sudarshan for his 9:10 call. Sudarshan?
Well, Hind Petro can be considered for buying Hind Petro with a stop under 403.
Okay, all right. Thanks for that. Mitesh, what about you?
I have a BPCL as my recommendation. Look for targets of 380.
Okay. All right. Thank you, gentlemen, for those calls. Let's quickly move on. There is a note from UBS on the two-wheeler segment. And it seems that they're striking a bit of an optimistic sort of call over here, if I'm correct. Let's ask Vinny for the details. Vinny, morning. What is UBS saying?
Good morning. So yes, at least for the consumer, it's going to be exciting because it seems like we're going to be seeing an increase in terms of discounts for two-wheeler vehicles as well. We've seen it in passenger vehicles, and now it's increasing in two-wheeler vehicles. That's the word coming in from UBS, especially in the e-commerce platforms. That's indicating a bit of a higher discounting here. They're saying there's a sharp step up in discounting for online platforms, which has increased competition and some bit of inventory pressure for companies. That's a concern coming in there. Now, they expect these discountings to remain high even during this festive season, which is just starting and just around the corner. Other than that, high discounting is seen for especially Hero Motor around 11 to 18%, while for Bajaj Auto also it's in the range of 12 to 16%. So talking about entry points for electric two-wheeler vehicles, that's significantly below the best-selling ICE motorcycles as well. So yes, electric two-vehicle, that is obviously a better option and attractive pricing versus an ICE bikes that we've seen coming in. TVS, that's gaining market share. Hero Moto is losing market share. So that is why they're maintaining a buy on TVS Motors, Eicher Motors, and a sell on Hero Moto and Bajaj Auto.
All right, Vinny, thank you very much for that. Naveen, fluorine is the next one we want to talk about. Sonal is here with that one. Sonal, morning.
Good morning, Prashant. Well, a lot of analysts, they visited CDMO facility of Naveen Fluorine, which is at Devas. And the takeaways were that management expects strong growth runway in CDMO business going forward on the back of scale of the Fermion contract. That is a big contract that the company has been speaking about for a long time. Company is targeting 40% CDMO revenues coming in from the late-stage molecules by end of FY25 itself. This would be a big trigger for the stock. Now, Naveen Fluorine is one of the two suppliers of an intermediate product which is going into Bayer's darolutamide, and the annual revenue potential here is around $25 million, which could rise to levels of around $75 million by FY29. And Naveen Fluorine says they can make up to 50% of this particular revenue potential in their books itself by FY29. So this is something that the street is very bullish on. They also say that the 540 crore specialty chemicals plant is expected to be commissioned by October end. However, the recovery in specialty chemicals which they had expected in the second half is not something which is confirmed. So this is something that could worry the street because China dumping and demand concerns in China still continue to impact the global chemicals industry. Jeffrey says continued channel destocking and Chinese aggression pose challenges to companies' intermediate heavy portfolio. They have an underperform with a target price of 3,000. Morgan Stanley has an underweight as well. They say near-term earnings are not yet fully de-risked, but upgrades still some time away. So these two brokerages are not bullish on the stock. However, Nirmal Bang has upgraded it to a buy. Target price has been increased, which is on the back of a rolling forward to the next financial year. They say worst is not behind due to macro factors, the biggest one being China competition, but margins are expected to improve from the current base because they were at multi-year low levels already. So that's why Nirmal Bang is positive on the stock.
Right, Zonal, thank you very much for that. So those are details coming in on that one. We'll just sort of count down to the market opening. The first rates should be up on your screen shortly, and we'll look at that. The indices, and we'll, as always, go into individual names and stocks. So what do we have? First rates coming through. The indication, of course, early on at 8 in the morning was about a 60-65 point cut. In the pre-open as well, the indication is about a 0.4, 0.5% lower start. So we'll see, we'll pick up from there. 26,061 is where the pre-open left off at. But the first rates around the 26,100 level on the Nifty, 85,300 on the sensex is what you have. So that's about a 1/3% lower on those two. Mid-cap index is starting down about 1/4%, 60,271. And as always, the IT services index comes up with a meaningful move. So the meaningful move today is down about 1% lower, nearly 1% down, 41,940 or so. So that's the IT services index. And take a look at the heat map overall. I mean, many more down as compared to up. That's essentially what you've got. So about 38 odd names, 35 odd names lower, 2 unchanged, and you've got and the rest which are trading up, or at least starting up at 9:15 this morning. Sirbi.
Okay, let's look at the individual movers and shakers. First, the company that we were just speaking with, actually, PB Fintech. Some recovery on the price again. The damage was quite severe in the last couple of sessions. There was some recovery on Friday, and it's continuing today, about 3% on the higher side. But anyway, let's look at the larger market move, the 100-point cut on the Nifty. To start off with, the bank Nifty is actually leading things on the way down with a cut of about 0.5%. So the banking pack is not really helping matters much. Aside of that, Hero Moto, Tech Mahindra, these are some of the weaker names. Reliance is down 1%. So that's cooling off. A lot of IT selling going on right now. Tech Mahindra is not alone. Infosys, Wipro, TCS, all the large cap IT names are on the way down. So banks and IT put together, not really very inspiring for the bulls this morning. However, on the upside, it is that metals rally. Remember, even Manisha was talking about it. Prices, I mean, base metal, ferrous metal prices, they've been going through the roof on the China stimulus, and that is continuing to percolate down into stocks. It was the best performing part of the market last week, and that trend continues. Hindalco, JSW Steel, and even the names beyond it, names like Vedanta, SAIL, Nalco, all of them are up and about. So metals pretty strong, banks and IT slightly weak. Mid-cap's absolutely flat for now.
Well, that's right. And you have, iron ore prices that are flying up. So NMDC, that's the core play on iron ore. So that stock is up close on 4.5%. And we are at CNBC-TV18 have been making this point on Vedanta. It's not for the faint-hearted, but if you're going to get a Chinese stimulus, if you're going to get Fed rate cuts, then that's the best way to play it. And I think the stock from there, it was at around that 450, 440 odd level. Didn't do anything much for a long time, but it's given dividend of close to 24 rupees odd. And after that as well, the stock is up more than 15% from those levels. So that's been one of the big players out there. Colgate is another stock from the frontline names that's up close to around 2.5%. So big move is what we're seeing out there. Tata Chemicals is another one that's up close to around 2.5%. What's not doing too well? NCC has seen some profit taking from the recent peak. That's down 2.5%. TVS Motors as well is down close to around 2%. From the broader markets, Reliance Infra, the stock has seen a big surge in trade volumes as well as rather high, because the Kolkata High Court has ruled in their favor with regard to an arbitration order. So that's one of the top volume movers in today's trading session. What else is doing well? A couple of smaller names. Vakrangi is up close to around 11%. I don't know whether there's any news flow. That's one of the top volume movers out there. And Z Media is another one that was this month. It's up close to around 60%. Well, I think they've announced some fundraise out there a couple of days ago. So that's another one that's moving well. All in all, the market's a little bit down, 80 points lower, but I think par for the course after the kind of rally that we've seen. Prashant.
No, absolutely. I mean, you got a 90-point cut now coming through, and that's the sort of state of affairs. Just a few other names before we bring in our market guest. PB Fintech is already giving up gains. It's at about 1660 or so, about 1.5% higher is all that's left. What else? I mean, there is NMDC, as you said, Nigel, 4%. That's the biggest volume-led gainer right now on the NSE. Reliance Infra, 2.5% higher, but that one has been a rocket. I mean, from 200 to 300 in 3 or 4 days flat. And it's starting another 2.5 higher right now. We've got LT Foods, which is up about 3.5%. Volumes actually at least with stocks which are up, not very much. I mean, tapering off, at least at start, not a very big volume-led day. Reliance Power, again, another rocket. It's down about 4% this morning, 45. It's the biggest volume-led gainer by far. Hero MotoCorp with a 2% cut is at number 2 position in terms of volume-led losses. Phoenix Limited, the mall operator, 5.5 lower, 1757 on Phoenix Limited. 70, so that's got tremendous volumes as well. And you can go down to JSW Energy, RITES, the recent listing Cross and Bharti Hexacom, and so on and so forth. So that's essentially some of what is coming through. Surabhi?
And we have to check on the new entrants in the Nifty, right? For what it's worth, I mean, just to market.
Yeah.
Trend is in. It's been a massive wealth creator. Today it's down about 0.1, 0.2%. Doesn't matter, but what a journey. And now it makes its way to the Nifty 50. And of course, BEL is keeping it company. BEL is down. All of PSUs are down. There's a general cool-off across the board. Railway PSUs, defense PSUs, SJV, and a lot of PSUs are down, including BEL. 2 new names on the Nifty.
It's a running joke between me and our producer, Anurag, about I really want to go to Zudio.
When will you do it, Rajat?
I've not been able to, but hopefully, right? I mean, that's essentially the big driver for this one. Really, so many sell-side brokers have covered the stock for years, have sort of said it on record that, well, we got this wrong. And we did not get this in terms of what a powerful engine Zudio's turned out to be for Trend. Well, let's welcome in our market master, Pankaj Tibrewal, founder and CIO at Ikagai Asset Managers, is with us. Pankaj, great to have you with us here on the program. Thank you very much for your time. So, at the margin, Pankaj, you've been cautious, right? You've been advocating that maybe the time has come to go a little bit more large cap. Too much concentration in mid caps, small caps and smaller caps, perhaps not a great idea. And now we're finally starting to see the breadth of this move narrowing, the breadth of the rally narrowing, Pankaj. So let's begin there. Your observations.
Good morning, Prashant. Over the last few weeks, we have met a lot of investors through different forums. Though the Nifty is making new highs, but you don't see that happiness on the face of investors because their individual portfolios have not participated in the rally the way Nifty has, gone up. And clearly, there are few observations, Prashant, which clearly is now being proved by the data. So if you look at from June till September now, and this quarter is coming to an end today, what we are seeing is the divergence between index return and median index returns has started to happen. In this quarter, NSE 500 index has given about 8.5% returns, but the median return of the index has been about 5.5%, which means the index heavyweight is leading the index higher, but the breadth of the rally has started to narrow. This brings us to the question, is the return of polarization, which has started to happen. And normally when earnings growth starts to slow down, which we saw in the first quarter and likely in the second quarter as well, we see that polarization happens. It happened in 18-19 as well. Still early days, but the question is the return of polarization starting to happen? In the mid-cap 150 index, 25 stocks have given the bulk of 50% return of the index. So clearly, you are seeing the median return trailing the index return, and this is the first sign. The second important observation in the market is that there is a style shift starting to happen. Over the last 3 years, you have seen value, momentum, high beta, and in certain areas, low PE doing extremely well. But over the last 3-4 months, post-elections, you are seeing growth, quality, and low volatility making a very sharp comeback. Please don't ignore this because whenever style regimes changes happen, it leads to realigning of your portfolio. It happened 3 years back. Probably interest rate cut may be the catalyst, but it is looking now that probably there is some change in the style which is starting to happen and portfolios need to adjust towards that. The third point is that we were in a way beneficiaries of Chinese underperformance. Look at the way the Chinese markets have bounced back over the last 1 month. Now, on a year-to-date basis, Chinese markets are outperforming Indian markets. In 1 month, it made the entire change. And hence, though FI flows were not very strong, but on the margin, it could impact the FI flows as we move ahead. Last but not the least, valuations are one standard deviation above overall market. And in certain pockets, it's crazy. Look at the SME part of the market. It's in a different frenzy altogether. 65 times the index is up over the last 5 years. So I think what I would suggest to most of your viewers and the investors in the market, this is the time to go back to basics of investing. Make sure that the quality of the company you are investing is not compromised, and make sure that the portfolio is resilient enough that whenever there is a drawdown, the portfolio stands tall. So these are the few things which is under your control, which you can do.
And hopefully investors are listening to a lot of that sane advice that we're getting in from market veterans like you, Pankaj. I mean, I think that was really well put. And just to sum it up, basically what you're saying, styles are changing. The market's going back to areas like quality, low volatility. Then there's a resurgence of China, and then we have lofty valuations in India. So it's a potent mix, right? Now, against this backdrop, the IPO market continues to sizzle. We have Swiggy coming up, we have Hyundai coming up, and so many more. So just allow us to play this one bite, Pankaj, before we sort of get back on that question of the IPO market. And this bite comes in from one of the biggest poster IPOs of 2021, Paytm and Mr. Vijay Shekhar Sharma. He was on a panel at an industry event, I think on Friday, where in his candid style, he went on to admit that one of the mistakes that he made in life was selecting the wrong merchant bankers. Let's listen into this and we'll come back to the IPO discussion.
I have a regret now, not in the joining of entrepreneurship. I've been entrepreneur for long enough now. I have a regret of not choosing the correct bankers for IPO. If you choose the correct bankers, जैसे भगवान के मंदिर में जाने के लिए आपको सही पुजारी चाहिए होता है, शायद हमने वो नहीं चूज करे तो उसका choose a right banker, my friends. अभी तो छोटी-छोटी IPO भी इतनी बड़ी हो जाती है. In Iran age, it was driver making 1 crore. In Paytm's case, I know 20 people who made ₹1 billion, 100 crores.
Excellent.
20 people. And many of them cashed out more than 100 crores. I'm a bootstrap entrepreneur who had to do a lot of cash generation by the business. And in that rush, I learned only one thing for ladies and gentlemen in the room. There's nothing called P&L. This profitability, which is a P&L, which is an opinion. The real truth is cash. Everything else is a trash.
Lessons learned in the heydays of the new age company bull market, right? And in hindsight, when you end up being a lot wiser. Anyway, let's get back to the question that I was asking, Pankaj. We are in the kind of market that we're in. We're getting a lot of new issues. Do you think mistakes would be made again? What's the advice that you would give out to investors so they don't have that repeat experience? I mean, not just Paytm. Several companies went through the crunch. Zomato came out triumphant. What is the one thing that you would advise to investors now as we're looking at these multi-billion-dollar issues that will hit the screen very soon?
So last year we did a piece on IPOs and I posted it on my Twitter handle sometime last year. And the data was staggering. Last year was one of the biggest years in last 20 years in terms of number of IPOs we saw. But if you look at a last 20-year history and IPO sizes of 50 crores and above, 53% of them underperform Nifty. So in the very short term, IPOs tend to look very good. But over a medium to long term, I think very few IPOs do well. And only 24% of the IPOs since 2002 have become 5-baggers or more. And 51% haven't even doubled post-listing. So clearly the data suggests that you need to be selective on the names which come for the market. And clearly on the SME side, we are seeing frenzy and euphoria. I think many of them will probably not see the value over the next 5 to 10 years. So the real advice would be, don't get carried away by greed. It's clearly visible on the street today. Take a more, saner call right now. Make sure that you do your proper homework before investing. Otherwise, in this kinds of market, the probability of making mistake could be much, much higher. And we need to be careful. And I am saying this again, that at this point of the market, we need to be risk manager rather than fund manager. Make sure that you appropriately price the risk in your portfolio so that you can survive on the pitch for a longer periods of time. For that, if you need to give few overs maiden, let it be. But don't lose the wicket. Otherwise, you won't be able to come back to the match.
Amazing. Well put, Pankaj. But, you'll be looking out for that loose delivery, right? To dispatch it to into the stands. And there's still some opportunities that are still prevalent in the market, be it from the power space, maybe some of the financiers as well. So give and take everything. You're sounding a little bit cautious, particularly about the broader markets, but you're still stating that there are good themes out there. So list a couple of them because our viewers would like to know where should they be building position with conviction for the next few years.
Good morning, Nigel. On the themes, I think power demand and electricity could be a slightly medium to longer term theme and energy transition. And look at some of the data points. After 15 years, US is starting to see increase in demand for electricity, led by data centers, EVs, and so on and so forth. You will be surprised to know that CY19 to CY22, out of the top 10 air conditioning installation markets, 8 were out of Europe. Who would have thought that Europe will install ACs far more than any other country? And 8 cities out of the top 10 are from Europe because of global warming. So I think there are 4 important points: global warming, data center, which is AI, electric vehicles plus Bitcoins and cryptos, and the constraint on transmission and ESG, which is leading to the entire energy transition and increase in demand for power. I think this could be played through various things: distribution, transmission, or generation, and the ancillaries to that. So I think it's a mega trend. Valuations could be something which is prohibitive right now, but keep a close watch on this trend over the next 5-10 years. The second one is the pharma sector. I think, broadly speaking, I think we have still some visibility on earnings growth there. And I think most companies will deliver earnings growth better than the broader market. And I believe that valuations are not so prohibitive there, whether it be the generic player, whether it be domestic or CDMO. I think pharma sector is looking okay. Financials, I believe, is one space where valuations in our favor, whether it be lending or non-lending. And I think insurance is coming out quite strong, as well as some of the banks and NBFCs. So that's another space where we are positive on. And auto ancillaries, don't forget that space. I think many auto companies are changing their texture, not only from pure auto to industrials. And I think that's a big shift which is happening. Who would, kind of expect that recently the global purchase head of Airbus was in India, finalizing vendors for the next decade or so. So I think a lot of areas like aerospace, defense, they are going through their own challenges of supply chain globally. And I think India is finding flavor. And many auto companies are transiting and pivoting themselves, not only from pure auto, but to industries, industrial areas like aerospace, defense. And these are some of the companies to watch out in the portfolio as well. So these are some of the areas where we think you need probably be a positive on. But I again repeat, it will be a bottom-up stock pickers market. The best of the breadth or the best of the broad-based rally which we saw over the last 3 years may be behind us, and the data is suggesting that. And probably our first quarterly newsletter will be coming soon. We'll be elaborating more on that as we move ahead.
But you gave us 3 or 4 broad themes to look for at least, right? I mean, it's become tougher, as you said. Power, pharma, financials, and auto ancs. These are 4 broad areas. And I like what you said. Be a risk manager rather than a fund manager now. I mean, you're in that phase of the market. So I think that's our headline from this one. Pankaj, I know you don't want to talk about single stocks, but just your thought process as an investor. You heard the news flow around. The case is this: PB Fintech. We had the management with us earlier today. Platform company, light asset model, it's done very well. Stock's phenomenal. It's doubled this year. And now it came off about 20% last week on fears that they're going to get into hospitals. Well, they've clarified they're going to do a minority investment up to $100 million one time into an operation which is going to be a network of hospitals. And it's now going to be done in PB Fintech, but an outside company. As an investor, how would you look at this situation? I mean, for those who own it or are thinking about this one?
Prashant, I think rather than commenting on stock specific, I would say that there are few thoughts about the new age companies. When I interact with a lot of them over the last few years, I believe that the private market and public market are 2 different animals. You could take a decision by speaking to 5 people on the private equity side when you are unlisted. But when you are listed, you need to be far more responsible because there are a lot more investors and the thought process is very different. I think we saw that in few cases where at the time of listing, the promoter, the company said, we don't care for profitability. We only care for growth. And over a period of time after listing, market showed that the cash flow is reality and rest everything doesn't matter. And the company came back to profitability and cash flow and see how the market rewarded them over a period of time. This is just one instance where the narrative at the time of IPO and after maybe 18 months of listing was very different and how markets rewarded them. So I think over a period of time, many new age companies, probably who don't have the experience of public market listing, will make those mistakes. But I think companies who kind of correct those mistakes also very fast will kind of move ahead with much, much better market capitalization. So I think it's a learning process. I'm nobody to comment whether the company you mentioned is taking right decision or wrong decision. Its time will suggest. But one should stick to the core. If it's an asset-light model, over a period of time, one should strengthen the moat on that and not pivot too much from their core. I would suggest that. And public markets are a very different animal than the private credit markets.
All right, Pankaj, thank you so much for joining in. And it's really important to get that voice of reason, slight bit of caution as well, perhaps keep it on the table, given the kind of market and the global environment that we're in. Great speaking with you today. Thank you very much for joining in. Well, speaking of the market, just a quick check. Yeah, the cut's actually gotten deeper. We're almost 150 down on the Nifty, so there is a fair amount of caution in the in the market today. Bank Nifty is down about 0.7%, and as we've been highlighting, the problem is both IT and banks. The twin engines, well, neither is firing today, and there's a bit of roundabout weakness. Even autos actually, Hero Moto, M&M. Look at Bajaj Auto, look at Tata Motors. There's no pre-festive cheer and that whole run up to the numbers which come tomorrow. None of that's showing up. So cool off in auto, IT, and banks. Well, let's then turn the spotlight on the housing finance space now. The cabinet approved the PMAY Urban 2.0, the Pradhan Mantri Awas Yojana, the 2.0 version, to talk about the potential impact on the sector and on individual companies. We have with us Rishi Anand, the MD and CEO of Aadhar Housing Finance, joining in. Rishi, great to have you on. So obviously, there's a fair amount of excitement around this scheme. We spoke to some of the public sector entities as well, and they were telling us about how this is sort of getting bigger and better. But you tell us, what is your exposure, first of all, in the first version? Was there any exposure you had? Did you disburse any loans which come under the first round? And now with this 2.0 coming in, what is the impact overall for affordable housing and, of course, for Aadhar in specific?
Great. First of all, good morning, Surbi. Thank you for having me. Okay. With regards to PMAY version 1, which got over in March 22, Aadhar Housing Finance gave out subsidies to about 82,000 customers, which was almost 50% of my total existing customers, to the tune of 1,800 crores of total subsidy. So we were a substantial player in the segment that we operate, which is typically EWS and LIG. As far as PMAY 2.0 is considered, or that has been, as you said, it's just got launched. The contours are almost out. I would say, and the industry echoes what I'm going to say, is it is a better version of PMAY. It is a very well thought through, drafted PMAY version. For example, while the total subsidy seems to be going down from a 2.5 lakhs to 1.8, but the subsidy now comes over 5 years. So it is total subsidy of 1.8 divided by 5 years, which effectively means for housing finance companies like us, the AUM, so the way it works is whatever subsidy comes to the customer comes in the loan account, which effectively means my AUM goes down by that amount. Now, in the current scheme, the AUM is the fall in the AUM is going to be split over 5 years. More so, the consumer will have to be non-delinquent for 5 years, and the percentage of BT out, which has been a concern in the housing finance sector, will also drop because the consumer has to be listed through one company and he has to stay with one company for 5 years.
Okay, so it tightens up maybe some of the, let's call them, maybe, loopholes or pitfalls that perhaps certain entities would have taken advantage of earlier. So it tightens up those loose ends, and the spread is now over 5 years, as you're saying. Now, let's talk about the numbers here and now. Let's talk about the FY25 targets. We're almost done with half the year. In terms of AUM growth and the total AUM, the size that you want your book to be at by the end of the year, what is that number? And this will only roll out, I guess the impact will start flowing through only in the second half, Q3, maybe Q4. What will be the exposure or expected exposure to PMAY 2.0?
So, Surbi, we've guided in your channel itself, we've guided multiple times that Aadhar is looking at a growth of 18 to 20% on disbursement, which will translate to about 22 to 24% on AUM. And as we speak today also, I would stick by those numbers, given the performance in Q1 and Q2. While the Q2 numbers are still to be published, but indications are good. Yes, you're right. The PMAY subsidy scheme effectively will be, I would say, October onwards. While the scheme says 1st September onwards, any consumer who is availed a loan is eligible for PMAY subsidy. But effectively, I think from October, mid of October onwards is when we are going to see some traction happening towards PMAY subsidies. I'm sure there is this question around what is the kind of growth that everybody is expecting or the industry is expecting out of the PMAY subsidy. For that, you will have to understand that this is a refinance scheme. So first we will have to go out and lend. Only then the refinance happens. I would say on an incremental basis, anywhere between 10 to 12% growth is what we are all looking at.
All right. Hi, Mr. Anand. Good morning and good to see you. Vince, you have detailed a fair bit with regard to the PMAY. Tell us about how do you see yields panning out? I think your yields currently are around 14% or thereabouts. You could correct me on that number. But you have been focusing more on LAP. So how does, change things from here on? And also your cost of borrowing. How does it compare with what we saw, say, in the first quarter from now? And how do you see things panning out from here on?
Okay, hi Nigel. Yes, one is, I think you had three questions. One is on cost of borrowing. Cost of borrowing, I would say, from our perspective, looks like they have peaked, and what we are going to see in the coming quarters is only going to be either, it's going to be cost of fund is either going to be flat or it's going to be slightly. We are expecting that December quarter there should be some announcement by RBI on the downward trend of yields. As far as our spread goes, we have maintained a healthy spread of 6%, and we've always guided the market that upward of 5.7% is the kind of spreads that we will maintain. Either ways, whether the interest goes southwards or northwards, we work on spreads. We have an 80% book which is floating, 80% liability which is floating. So whatever comes in terms of incremental yields, incremental cost of borrowing will be passed on to the consumer either ways. So that's how our spreads are. Yes, on incremental yields, we are at 14%. On the book, we are at 14%. Incremental, we are at about 13.6, 13.7%. So I think I missed one of the questions you asked. If you can come back on that.
LAP as a percentage of your total mix has been moving up, I think so. How do you see that panning out?
The LAP, right?
Yes.
Okay, so loan against property, it's a part and parcel of the mortgage business that we do. As the regulator allows us, Nigel, 60% of our balance sheet has to be individual housing loans, which would translate to, for a layman, would translate to about 70% and 30% home loan and non-home loan respectively. Today, Aadhaar stands at about 25, I think, and the management has also guided multiple times. We will be at 75-25% home loan to non-home loan. So I would not say there is a substantial increase. In fact, it is a calibrated increase on loan against property, and that's where we would want to maintain at about 25%.
Mr. Anand, hi, good morning. This
good morning,
majority of this comes from resale and sort of self-construction, etc., right? Has in the segment that you operate, has real supply started to come in a big way on the affordable side? Not yet.
So I would say, since we work primarily, Prashant, we work in the affordable segment. A majority of our consumers would buy properties which are already built, which is resale, as you said. There will be a 30-35% of the consumers which would construct on existing plot. Now, construction on an existing plot is actually creation of a new asset. So asset is getting built with that kind of loans. On the affordable segment, there is multiple state governments. There are multiple projects that have come in right from at various stages. We are currently, as we speak, talking to CIDCO on a big chunk of projects that have flats that have come in. So there are multiple states. I remember talking to Tamil Nadu about a couple of Tamil Nadu government, state government a couple of weeks back, Karnataka government, MP. So there are multiple states who've taken already lead into providing affordable housing. So it's a good place to be in today.
Okay, but yeah, no, I got that. So is getting you have the visibility of supply because we've had people who started with affordable housing going into premium because that is where the demand is, the money is. But you're saying that at least government initiatives, state government level, etc., there's visibility of a lot of supply now.
So yes, I would say two things here, Prashant. One is, yes, is there a visibility of supply? I would say completely yes. As I stated, I have been personally interacting with state government bodies, so I can there is a clear visibility. More than that, there is a lot of availability of properties in the outskirts of larger cities that we operate. So my consumer, irrespective whether he's buying from a government-led initiative or he's buying on resale and self-construction, the demand is looking very positive as we speak, Prashant.
Okay, all right. So we'll leave it on that note. Thank you very much for joining in. Good getting that perspective from you today. That is Aadhaar Housing and how they see the road ahead and, of course, how they see PMAY 2.2 also, sort of boosting their business this year. Stocks down about 3.5%. And with that, quick check on the market as well. The cuts are getting deeper. 172 down and 26,000 is under question as well. By the way, let's do a quick check on the rest of the region as well. While we are sliding quite a bit, look at the Hong Kong market and look at the mainland China market. And this was the question always. Will there be some rotation away from India into China? Too early to call any parallels over here. Hang Seng is surging 3.5%, and then mainland China ahead of the holidays that are coming up, this Golden Week period, 6% up on the Shanghai Composite. That is what mainland China is doing, while Japan is still down about 4.5%. So pretty dramatic moves across Asia today. Let's take a break on that note. Coming up on the other side, we discuss, of course, some of the changes that have been announced by the exchanges in terms of the fee structure. Now they have to move towards a flat fee and not the slab-based system that was followed earlier. What does this mean for transaction charges? We'll ask Rajesh Palvia of Axis Securities in just a bit. Welcome back. Well, let's get the conversation going around the new regime which kicks in from tomorrow with respect to transaction charges that market infrastructure institutions, MIIs as they're called, the system that they will have to now adopt. And in line with the regulatory changes, NSE and BSE have revised transaction charges to comply with SEBI's directive requiring them to do away with the slab-based fee structure that was prevailing earlier. Now, one has to look at a true-to-label fee structure, which is based on average realizations. And the question is whether it could perhaps impact revenue for brokers, particularly discount brokers. To talk about this, so we have with us Rajesh Palvia, VP Technical and Derivative Research at Axis Securities. Rajesh, thanks for joining in. Now, this is something that's been discussed, I think, over the last couple of months since this was announced, this flat fee structure. What is your take now that brokers can't pocket the difference between how much they're collecting from the end user, which is me, and actually paying to the exchange? What happens now? And break it up into different, class and category of brokers, from the discount guys to the regular broking institutions.
Good morning, Surbi. So definitely the circular came in July to all market infrastructure institutions that, they cannot have now slab-based mechanism to facilitate all these brokers. So I think now it's a fixed charges, all transaction fees they are charging to the broker. It would be a fixed charges. They cannot have slab mechanism based on their market share. So discount brokers were enjoying this, slab-based structure much because they were attracting more, volumes in terms of as they are charging very low brokerage or, zero brokerage kind of structure. So I think the major participations were attracted by the major derivative traders were attracted on the discount broker. So I think there could be impact on their, volumes, and maybe what benefit they are getting by these slabs will impact to their profitability on an immediate basis. But the way Nifty has changed the structure now, the cash segment now will be having 2.97 for per lakh, and for equity future again they will be having 1.73 rupees per lakh, and for equity options it's 35.03 for per lakh of premium value. So this is the flat transaction fees they have to charge to the client now. There will be a level playing field for all the brokers. So client will not have any kind of differentiation across all the broker community. They will be having the same structure in terms of charges, because what has impacted those who are high frequency trader, those who are doing bulk trading, or those who are having high volume, they are the cost is the major key driver for those to deploy all algo kind of strategies. So they will be impacted by this thing, but brokers on the discount broker will get the major hit by this thing.
So Rajesh, let's just take the rates are on the screen, the ones that you mentioned. Let's just take that example, the equity options segment, because that's where we're getting so much of volume, where the earlier band was 29.5 to 49.5, and now there's a midpoint, flat 35.03, as you said. The question is, will broking costs go up for the end customer? Zerodha, has come in and made that statement that their revenues are going to be hit. Is this the end of discount broking? That's question number one.
So definitely to meet out the revenue difference, I think they have to increase the brokerage structure to meet out all this the difference which they were getting by the transaction fees slab structure. So I think yes, definitely there will be an increase in the brokerage by the discount broker. So that will give impact to their business volume also, because now there will be a similarity in the charges between the full service broker as well as the discount broker. So yes, there could be some hit on the brokerage side. So client have to give more brokerage on the discount broker platform also going forward.
All right. Hi, Rajesh. Good morning and good to see you. And let's talk about the exchanges then. Everyone's debating NSE will list or will not list, but BSE is running away and the stock has been on fire. I think in the last 40 days, the stock is up close to 25% or thereabouts. What are you making of the current valuations? If you could give us an update first on a forward multiple, what is BSE trading at? And do you think it's trading at very elevated multiples? Because there are some curves that are coming into play with regard to transactions, with regard to volumes as well, which could be a risk to earnings. So your take.
So I think on the exchanges front, I think there won't be any major difference, because they will be getting the same charges, and there is no as such changes from their revenue front by this transaction fees, because they will be getting the same transaction fees what they are charging. So I don't think there will be any changes in the revenue of exchanges. But yes, the way BSE has moved up in anticipation of that, NSE there could list, and that the peer company benefit, and most of the participants have participated in BSE because it's available on the exchanges. So I think that has stretched the valuation at this juncture, and the way stock has moved up, yes, definitely it's at a stretched level at this moment. But on this transaction fees, I think there won't be any changes in the revenue of exchanges.
Got it. Transaction fees aside, what is the multiple it's trading at, BSE? Yeah, the valuation multiple you were telling us about BSE, that's trading at fairly elevated levels. You made that point, but if you could give us the number.
That I don't have a ready number with me.
Got it.
Okay. So, Rajesh, the point that you've made is that this should be largely revenue neutral for exchanges, but it's a question of what brokers do now and whether the discount brokers start increasing pricing. I know, this is not a space you track. You're not a fundamental analyst on capital market institutions, but nonetheless, I remember having a conversation on this when the original regulations were announced, and one counter thought process there was that it's still a very competitive market. You still want to do volumes, you want to catch in the retail, you want to get the larger institution, the algo guys, like you said. So it will prevent, in general, a rise in, too much of a rise in broking fees, and it will remain very competitive. While discount brokers will have to actually hike, the basic broking charge, there are other levers which they could adopt as well to overall keep costs low. Is that a scenario that could play out? What's the final sort of word on this, you think?
So definitely the brokerage is the only tool where they can, compensate all this, the slab hit which they have got by this flat structure. So I think there would be increase in the brokerage going forward. As we have seen, in last couple of years, the major traction which we have, attracted on the derivative market is because of the one of the reason is, low brokerage structure for this discount broker, and they have facilitated most of the traders by, charging low brokerage. And now we have seen, a huge rise in derivative volume. So and a lot of concern raised by the regulators also by seeing this kind of, extraordinary volume, which we are seeing in the option market as well as in the derivative market. So a lot of measures they are considering a lot of measures to, curb these kind of, extraordinary activity and to protect the interest of retail clients, those who don't have, edge on the derivative market. So I think by increasing these charges, I think there would be some volume activity would be dry up, and as well as the another measures which going to come after this SEBI meeting today. I think another measures will also, give some, volume dry up going forward. So I think the concern is it has to be level playing field. There should not be any discrimination between the larger player, but between the and the retail player, and there should not be any discrimination between the broker to broker. So I think it's going to be a level playing field for all across the broking community, as well as it will help to the traders also.
Okay, well, let's hope it plays out well. Thank you very much, Rajesh, for giving us some perspective in this. So new regime in terms of transaction charges kicks off from tomorrow. By the way, on the market, interesting trends. We dipped below 26,000. Now there's a bit of an attempted recovery. The only thing that's seeing buying in the market today, by the way, is metals, thanks to China's roaring rally. And then there's a lot of consumer that's on the green side today. Asian Paints, Tata Consumer, Lever, Titan. These are stocks that are up. And the reason now the Nifty is fighting to get back about 26,000 is actually IT. Remember, at 9:15, a lot of IT stocks had opened weaker. But the mood of the market seems to be move towards cash, move towards safety. And FMCG and IT fit right in that equation. So look at from the lows and HCL Tech, Wipro, a lot of these IT stocks, they're recovering from the opening gap down level. But Prashant, it's really, stark the difference between the whole India-China, just in terms of how the equity market is reacting today.
Absolutely. It's like all over the place, right?
Yeah.
But for specific, I think Japan is still down. China is up. Here we've got this going on. So, I mean, just above the 26,000 level now as we look at things. Mitesh is with us with what he'd want you to do. Mitesh was telling us in the morning that he'd expect maybe a sideways kind of market till, I think, noon tomorrow. And then, of course, you go into a holiday on Wednesday, midweek one. Mitesh, go on. What's your take on things now?
So, Prashant, the sideways to a mild pullback is what I was expecting, and the first target was around 980-600 zone, 26,000 zone. Sorry, I think that's been tested. If we don't break today's low, I think sometime during the day we'll get a mild bounce back, and that would be a long trading opportunity. And in the worst case scenario, I'm penciling in a test of 25,800. So I think we'll wait it out. Another few hours, we'll know whether we're getting a pullback from these levels or whether we'll test 25,800 before bouncing back. There's a good congestion of moving averages as well as retracement areas around 25,800. So that is the bigger support level. But since we have kind of managed to hold on to the first level around 25,980, I think we'll keep a watch. But the overall trend is still on the positive side, even if we go down to 25,800. After 8-9 days of rally, this will be a 2-day, 3-day kind of a pullback. So nothing much to worry about as of now. But yeah, you might want to tactically wait it out before you want to take a fresh position on the index. On the stock side, a Pidilite is a buy. Keep a stop below today's low of 33.50. Look for targets of 34.75 to about 34.85. And the other stock which I like is Polycab. It's giving a good pullback. So buy here with a stop below levels of 68.50 and look for a target of around 7,200.
Got it. All right. Thanks a lot, Mitesh, for that. So not too perturbed with this bit of a dip that we're seeing this morning. And it's saying till that 25,800 level holds out. That's the first reference mark. Mitesh is not too worried. Well, let's shift away a little bit from equities and focus on the commodity market. Manisha Gupta joins us to help us with the sector of the day yet again. Manisha.
Thank you for that, Nigel. Well, I'm looking at metals as a sector because we've seen constant gains onto this one. The last 3 weeks actually have been quite strong, and that is the reason the month of September is headed on a stronger note. This is on the back of very strong China stimulus. Well, almost this has been the most aggressive stimulus since the pandemic. So whether it has been about mortgages, making injections, financial injections, that is, into the economy, and then it also has been about easing mortgage repayments, borrowing costs have been reduced. So all of that really has helped the metal prices in sentiment right now, because the factory activity numbers that we saw come in from China have been on the weaker side yet again for the previous month. But the expectation is that the steps that China has taken, we will start to see those signs in the final quarter of this calendar year. The best of the gains really came in for the copper prices, 7% of gains in the previous week, and this has been the best weekly gain that copper has seen in last 4 months. Well, the other reason that you also have seen copper prices gain is because the inventories have slightly declined, and the markets are looking at stronger data demand coming in also from the European markets there. Not just copper, nickel is trading at a one-month highs. Iron ore prices in the previous week gained up by 11%. That is because the China port inventories in case of iron ore have continued to decline. And then there have been weak shipments from the major producers like Australia and Brazil as well. We also have seen strong gains continuing in case of zinc because the projects which were expected to start for the second half of this year now have been postponed to mid-2025, also supporting. Silver also has continued to gain. We saw a 12-year high in the previous week, some profit taking from those kind of levels, but that clearly has been the gain in sense of gold as well, where we did see all-time highs in the previous week. Some profit taking is how we are working with right now. China, of course, is the largest consumer of silver, have been buying a lot of gold as well in most part of last couple of years as well. And the markets do believe that all of these dips will be used in case of buying there. Just to show you on how the metals have worked on a week-on-week and a month-on-month basis, as you can see, from 3 to 8% of gains is what we've seen in the last week. Copper gained up by 7%, zinc 8%, iron ore prices gained up by 11% as well. The last 1 month, that is the month of September, also has been very good for the metal prices. 7 to 15% of gains is what you can see onto this one right now. For the overall year 2024 as well, it continues to be quite well for the metal prices. So 17% of gains coming in for copper in this year until now. But the best of the gains, as you can see, have been in case of precious metals, with silver clearly outperforming all of those metals for 2024 till time with 37% gains, 30% up for gold as well. And as you can see, 11 to 20% of gains is what we've seen in case of base metal prices also. It's going to be an important week, this one, because one, you have various data coming in from US, but most importantly, it is going to be the US Fed chair speech that the street will be watching out for. There is a lot of data coming in from the European countries as well, but inflation will be top on charts here. From Japan, you have industrial production numbers, unemployment and retail sales. And from China, the street will watch out for the cakes in manufacturing data and the PMI numbers. Well, all of that data comes in this week itself.
Parisha, thank you very much for that. So that's a lot of action as far as commodities and all driven largely by what's happening in China. We'll take a quick commercial break here. We'll get you an exclusive conversation with Anil Kumar Gupta, Principal DG, Director General of Directorate General of GST Intelligence. That conversation is coming up. My colleague Timsy will be conducting that interview. Stay tuned.
Right, welcome back. Let's straight away head across to our colleague Timsy Japuria, who is in an exclusive conversation with Anil Gupta, Principal Director General at the Directorate General of GST Intelligence. Timsy, over to you.
Well, the Directorate General of GST Intelligence has detected the highest ever numbers of tax evasion cases, totaling approximately 6,084 cases involving over 2 lakh crore rupees of GST, which was evaded in FY24. According to the annual report of the DGGI, the Central Investigation and Anti-Evasion Arm of the GST at Centre, the sectors with the highest evasion were online gaming, banking, financial services and insurance and services, followed by iron, copper, scrap and alloys in goods. The evasion detected in FY24, remember, is double to what was detected in FY23, which was about 1 lakh crore rupees, involving cases over 4,800. Joining us today, Principal DG, who heads the Directorate General of GST Intelligence, Anil Kumar Gupta. Very warm welcome, sir. To begin with, let me ask you, monitoring and enforcement has played a critical role in the success of GST in India. And an interesting case that came to the fore was that of Infosys. It was in July when DGGI issued a pre-show cause notice to Infosys for alleged evasion of over 32,000 crore rupees of IGST between July 2017 till FY 2022, out of which 3,898 crore worth notice for FY 18 was withdrawn. So where are we currently on this demand?
Thanks, Timsy. Good morning to everyone. In fact, it's true that the intelligence and investigating arm of any organization, CBIC like DGI, plays a very important and crucial role in ensuring the compliance of GST law, which is the mandate and role of DGGI, and also in that process to check black money. So in that role, we, beside booking cases and detecting cases and finding newer modus operandi in which some of the elements or some of the taxpayers are very minuscule who play with the GST law and evade taxes, we book them and bring it to the fore. And DGI, in fact, besides ensuring compliance of GST law, also in that process educates and brings transparency in the way the GST law is being complied by the taxpayers. So as regards your question about Infosys, yes, Infosys is a long story. In fact, DGA was investigating this case since 2020. And in between, somewhere towards the beginning of this current financial year, about February, March, we came to know that state GST is also investigating into this case. And as per the mandate of the GST Council, that when multiple agencies are investigating a same taxpayer, in that process, we transferred the case to state GST authorities in April or so. But later on, there was some High Court matter in Karnataka High Court where Infosys has challenged the authority of the state GST authorities, and in that process there was a dialogue between the state and the center, and again this case came back to us towards the end of July 2024. But before that, state GST authorities had already issued a DRC-01A, which is a pre-show cause notice to Infosys of about 32,000 crore or so. But when the case came to us, we issued the DRC-01 since we are investigating that case. And the issue in brief is of import of services made by Infosys from their branch offices for execution of their export orders. So the matter as stands, of course, now for the remaining years from financial year 2018-19 onward, the issue is under examinations because the circular which Infosys claims that they're entitled to it, Circular 210 of GST Council, which was issued recently after GST Council meeting in June 23. That is the issue in brief, whether that...
So where are we currently on this demand?
...is available to Infosys or not.
What is the current
this
status
demand
of
is
this?
pending, and still because Infosys is to file a reply. Infosys is yet to file a reply for this remaining 4 years. Once they file the reply, only then we will examine, because it's a pre-show cause notice. In the GST law, for issuing a show cause notice, you issue a pre-show cause notice and then give an opportunity to the company or the taxpayer to file a reply. Once the Infosys files the reply, we will examine, then accordingly decide on the matter.
So recently, sources claim that the government is considering amendments in the GST Circular 210, which talks on valuation of supply of services import by a related party where recipient is eligible to full ITC. To make it simpler, it's correct. For the correction of the interpretation, this circular was issued. It is understood from sources that this circular could be tweaked further to give a relief for Infosys. Do you think this is in offing?
Yeah, well, it's difficult to say what is in offing and what is in the pipeline, because all such decisions are taken by GST Council, apex decision-making body. What I can say only is that we have suggested, we have also made a reference to the board, our policy wing, giving certain difficulties and implications of Circular 210, which are under examination in the board. And once a call is taken, the future course of action of that circular will be decided.
So what do you think can be actually done to give relief to Infosys? Is there an intent within the government to do so, or you think that the case is strong enough and government should pursue the case towards plugging this leakage?
No, this question has two arms. First is whether our case is strong or not. That I will say we only book cases which are legally sustainable and as per the GST law prevalent at that time. So whatever DGI has done, it is as per law. There is nothing wrong in that. The second aspect is whether government intends to do any relief to Infosys. That is up to the government. Government is considering weighing all pros and cons, and Infosys is a premier IT company of India. Whether such transactions need to be taxed or not taxed, that is the prerogative of the government, and whatever the government will decide, will implement accordingly, because we are the implementing arm of the government, and policy making arm is to decide what is the future course on Circular 210.
So coming to the insurance services, recently notices were sent to as many as 20 general insurance companies operating in SEZ units for alleged evasion of about 20,000 crore rupees as unpaid dues for services furnished before the employees of industrial units within these zones and their families. Companies such as HDFC Ergo General Insurance, Star Health and Allied Insurance, Cholamandalam, MS General Insurance, etc., they were issued notices for IGST dues alleging misuse of provisions that exempt certain SEZ services under Section 16 of the IGST Act. What is your view on this? Is there an intent in the government to clarify this issue? Or again, as I said, are you going ahead with this demand to plug this leakage of 20,000 crore rupees, making these insurance companies pay back?
Yes, basically these are the supplies which insurance companies have made to the units located in SEZs, and normally a supply to SEZ is exempted, and that is what the insurance companies have taken the benefit. But however, when we found and went into details investigation of these insurance companies, we found these were not actually supplies to the SEZ units by the insurance company. It was in fact a supply for ensuring the life of the employees and their families, employees of the SEZ units and their family, which is not a supply per se to the SEZ unit, which is exempt. So this is clearly a taxable supply for which insurance companies are liable to pay. And let me place on record that some of them insurance companies are already paying tax on GST on this kind of a supply. And we also found that some of the insurance companies, while paying in one case, were not paying in another case. So this is as per the GST law. It is a clearly taxable supply, and for which we have our Mumbai Zonal Unit has investigated cases and issued show cause notice to various insurance companies.
So we saw the GST Council setting a lot of pending issues. They have settled, for example, for the insurance sector only. 53rd GST Council settled the cases where GST Council has taken note of the industry representations and clarified in favor of the insurance sector with respect to co-insurance, reinsurance, wreck and salvage, etc. Is this matter of IGST dues from the SEZ units covered in this particular clarity, or this is separate from what came in the GST Council?
No, what 53rd GST Council meeting and the circulars thereafter had clarified, this current issue of supplies to SEZ is not covered under those clarification and was not the subject matter of discussion for those issues which were before the board or the GST Council. This is a separate issue, independent issue, which is not covered in those clarifications of co-insurance, reinsurance and other sectors.